the Fed is going to realize they've made a terrible policy error. This will go down, when we look back in history, this will go down as probably one of the three great policy errors in the last 200 years.
In today's video, Mark Yusko, the founder, CEO and CIO of Morgan Creek Capital Management, discussed about the Fed raising interest rates and impact on all markets including crypto, the crypto bear market, and if we've hit the bottom on Bitcoin. Before listening to him, please ensure to smash the like button and subscribe to the channel.
The Fed is going to realize they've made a terrible policy error. This will go down, when we look back in history, this will go down as probably one of the three great policy errors in the last 200 years. I know, big statement, but you know, we didn't have a central bank in the 1840s, but the national banks, actually we didn't have a national bank either. We had state banks back then. We were in the free banking era, but the state banks kind of collectively made probably the biggest policy error and plunged the country into a pretty significant recession. I mean, depression that no one ever talks about because it was back in the 1800s. Right. Then we had the second worst set of policy decisions, which would have been in 1930. And that was a combination of Congress, Smoot and Hawley, dumb guys that passed tariffs. Tariffs, never a good idea. Never have been, never will be. You know, Adam Smith was right. Comparative advantage and free trade and globalization are all good things, not bad things. And then on top of that, the Fed, which had just been established probably 15 years earlier, 17 years earlier, decided to tighten into a recession and turn a garden variety recession into the Great Depression. 1931 was the worst year in equity markets, not 1929 or 30, 1931. And so here we are again, 90 years later, and it's always 90 years. There's this 90-year cycle. It takes a full generation for people to forget. And so here we are again on the verge, and not even on the verge, we're in a recession. Yeah. It's like a modest recession, like a 2001 recession. It's not the end of the world recession. But the Fed, I believe, has made an epic policy error by over-tightening and exacerbating the problem. And it's not just in the U.S. I mean, it's everywhere. Every central bank in the world has decided to try to defend their currencies, except the Japanese and the Europeans. But that's another story for another day. But look, what I was saying was when the Fed realizes the error of their ways and they hint, they don't even have to do it. All they have to do is hint that they're either not going to raise rates or they're going to get back on the QE train, which they will, right? Japan said they would stop QE in 2008. They're still doing it today. Once you start, you can't stop. It is impossible until you do a debt jubilee. So once that pivot happens, the Powell pivot, as I refer to it, there will be a face melter of a rally. And I said, we saw a hint on Monday and Tuesday. We saw back-to-back 3% up days. And it's just short covering. All it is short covering. We have companies that are down 90, 95, 98%, and everybody's short. And if those things have to get covered, you know, you go from 2.5 cents on the dollar to 5 cents on the dollar in a hurry. Now you're still down 95% from a year ago, but you could have a really material rally. The problem is those are bear market rallies, right? There's never been a 4% up day in a bull market. Yeah. And it makes sense, right? A bull market is a market that goes up most days, but goes down sharply on bad news or perceived bad news. Okay. A bull market is a market that goes up most days and goes down sharply on bad news or perceived bad news. So what we had is a market that goes down most days since last November. And we had this good news or perception of good news. We didn't even actually have any good news. There was an emergency Fed meeting on Monday. Right. We didn't hear anything about it. They didn't make any declarations. They didn't say they're going to stop raising rates. All people did is say, well, Credit Suisse was on the verge of bankruptcy. Deutsche Bank on the verge of bankruptcy. Right. So clearly the Fed must have decided that they're going to ease.
Something's up. Yeah, something's up.
They didn't say that. But the market didn't care. They didn't wait around to hear. They just started buying. And let me just say that when I'm talking about the face melter, I'm really talking about equities, right?
About what?
I think
Repeat.
Equities, the equity markets.
Okay. All right.
In crypto, I think we're spring, right? I think crypto winter ended on June 13th. I think we're in crypto spring, which will last through first quarter next year.
Okay.
And what does that mean, right? Well, crypto winter is where you go down a lot, right? And we went down, 70 something percent peak to trough.
Oh yeah.
And we bottomed on June 13th. And now we've kind of bounced around the bottom here. And that's spring. Spring is, think about spring, right? It's cold, it's warm, it's windy, it's muddy. It's kind of, And so everyone's saying, oh, we're going to have this bull market. No. The thing about crypto, the reason sentiment's so washed out is Bitcoin is the cheapest it's been other than 3% of the time, right? In only 3% of 14 years has Bitcoin been cheaper relative to its history. So that's why people are so unhappy. Now, the markets, on the other hand, the equity markets are still, despite being down 21% year to date, they're still in the 93rd percentile expensive. Stocks could fall 50+% just to get back to fair value.
So your theory is that possibly the stocks go down, Bitcoin holds? Is that what you're thinking? I
absolutely think that could happen. And why? The reason, if you look at a history, 14 years of history, Bitcoin is 0.0 correlated to bonds and 0.15 correlated to stocks, meaning the directionality of one has nothing to do with the other. 0.15 is a really, really low correlation. But everybody says, but Mark, November to June, it was 70% correlated. Yes, it was. Because what was November to June? November to June was one of the great liquidations of leverage that markets have ever seen. We had the most leverage in equities in history. Margin debt was the highest it had ever been. And we had the most leverage in crypto. Michael Burry pointed this out actually a year ago, February. So he was way early to say, look, there's just too much leverage. In a liquidation, right? When Peloton goes down 95%, and you get a margin call because you bought Peloton on margin, you don't get to sell Peloton to pay back the margin because it's not worth anything. You have to sell bonds, cash, gold, Bitcoin. So what happens in liquidations, go back to March 2020, everything fell. But then Bitcoin rallied really hard off the bottom, up much more than stocks. Why? Because it's uncorrelated over the long term. But in those short windows of liquidation, where the leverage was coming out of the system, people have to sell what they can sell, not what they want to sell. And that's why bonds did so poorly. I mean, that and rising interest rates. It's why gold has done so poorly. Everybody says gold is supposed to do well in a recession. Well, it normally does, unless you have to sell it to pay back your margin debt, which is exactly what's happened.